Asian financial markets are surging with optimism as November 2025 begins. Major indices are hitting multi-year highs, fueled by a temporary US-China trade truce and the relentless momentum of artificial intelligence. The MSCI Asia-Pacific Index is up over 27% year-to-date, its best run since 2017, while South Korea's Kospi and Hong Kong's Hang Seng are also posting impressive gains. This broad rally signals renewed risk appetite, with investors betting on stability and tech-driven growth. US and European futures are following suit, reflecting a global wave of positive sentiment. The trade truce and AI boom are clear catalysts, but trading volumes are light. Japanese markets are closed, reminding us this rally may lack deep conviction. Investors are celebrating, but remain cautious, knowing sentiment can shift quickly. The big question: will these catalysts sustain the rally into 2026, or is this just a brief calm? For now, optimism reigns, but watchfulness lingers. The US-China trade truce is the linchpin of the current rally, offering a year-long pause in new tariffs and trade restrictions. China's suspension of rare earth export curbs and US semiconductor probes has reassured markets, especially in export-driven Asian economies. The truce removes immediate threats, giving businesses and investors a clearer outlook, at least for now. Yet the core disputes, intellectual property, market access, national security, remain unresolved. With the US election looming, political pressures could easily reignite tensions. Analysts warn this is a ceasefire, not a peace treaty, and history shows reversals can happen fast. Some strategists believe the good news is already priced in, urging investors to consider defensive moves. The truce is a welcome reprieve, but the underlying rivalry between the world's two largest economies will continue to shape markets. The peace is real, but fragile. The AI boom is the other major force propelling Asian markets, driving massive investment into chip makers and tech firms. Asia's leading role in the global tech supply chain puts it at the center of this surge, with upcoming earnings from AMD, Qualcomm, and Palantir under the microscope. Investors want proof that AI investments are translating into real profits, not just hype. Even non-tech giants like McDonald's and Uber are touting AI-driven efficiencies, showing the technology's reach. China now accounts for 40% of global semiconductor equipment spending, racing to build its own chip industry. Still, caution persists. Nvidia's CEO recently sold $1 billion in shares, raising eyebrows about lofty valuations. The AI rally is hot, but any earnings disappointment could trigger a sharp correction. For now, faith in AI's promise is strong, but companies must deliver real results. US monetary policy is adding complexity to the global outlook as the dollar surges to a 3-month high. Despite an October rate cut, hawkish Fed comments have dampened hopes for further easing, sending the dollar higher. For Asia, a strong dollar is a double-edged sword. It boosts exports, but raises the cost of dollar-denominated debt. The yen, euro, and pound have all weakened, reflecting capital flows toward US assets and higher yields. Currency swings add volatility for investors and multinationals alike. The Fed's stance signals confidence in the US economy, but a stronger dollar tightens global financial conditions. For Asian markets, the benefits of trade stability and tech growth are offset by currency headwinds. Investors must balance regional optimism with the realities of US monetary policy. The dollar's strength is a reminder that Washington's decisions ripple worldwide. The balancing act continues. The ongoing US government shutdown, now in its second month, adds another layer of uncertainty. The biggest risk disruption of key economic data, leaving investors and the Fed flying blind. Delayed reports like non-farm payrolls force reliance on less reliable private data, increasing market volatility. The Fed's job is harder without clear labor and inflation numbers, raising the risk of policy missteps. For global investors, this uncertainty is a major risk factor, with potential ripple effects across currencies and capital flows. The shutdown is a stark reminder of how political dysfunction can threaten market stability. While Asia celebrates the trade truce and AI boom, Washington's gridlock looms in the background. The longer the shutdown drags on, the greater the risk to confidence and economic momentum. Commodities are telling their own stories. Oil prices are firm, gold is surging. OPEC Plus's decision to pause output hikes has kept Brent and WTI crude prices steady, with banks like Morgan Stanley raising forecasts. Stable oil prices help producers, but can raise costs for consumers and stoke inflation if they climb too high. Gold, meanwhile, has jumped above $4,000 an ounce, reflecting lingering investor anxiety despite the market rally. The precious metal remains a hedge against uncertainty, but faces headwinds from a strong dollar and easing trade tensions. China's end to tax incentives for gold could also dampen demand. Gold's future will be shaped by the tug-of-war between caution and macroeconomic forces. Oil and gold are moving on diverging paths, each signaling different investor concerns. The commodities market remains a barometer of global sentiment. The Asian market rally is real, but so are the risks. The trade truce and AI boom have reignited optimism, pushing stocks to multi-year highs. Yet the truce is temporary, and the AI surge depends on companies delivering real profits. Much of the good news may already be priced in, leaving markets vulnerable to disappointment. A strong US dollar and the government shutdown add external pressures, complicating the outlook. This is a cautious rally. Opportunities abound, but so do uncertainties. Investors are balancing hope with realism, knowing the landscape can shift quickly. Whether this is the start of a sustained upswing or just a brief respite remains to be seen. For now, markets celebrate the calm, but eyes remain fixed on the horizon.